the watcher. They know everything about the market and do absolutely nothing with that knowledge. 5 finance apps on their phone. They check futures before breakfast. They can tell you what the Fed said last Tuesday and what it means for rate expectations. But if you look at their actual brokerage account, it is all cash. Has been for years. Every dip is not the bottom yet. Every rally is too late to get in. They have been waiting for the perfect entry point since the S&P was at 4,000. It is now past 7,000. They watched it happen. That is all they did. Their market knowledge could fill a textbook. Their returns could fit on a sticky note. The boring one. This person owns one thing, maybe 2, an S&P 500 index fund and possibly a total bond fund. That is it. They do not check it. They do not talk about it at parties. If you bring up a hot stock pick, they will smile politely and say something like, "Yeah, I just do index funds." Meanwhile, roughly 79% of professional fund managers, people with teams, Bloomberg terminals, and 6-figure salaries, consistently fail to beat the S&P 500. All of them losing to someone whose entire strategy fits in one sentence. The boring one does not care about being right. They just keep buying the same thing every month like they are paying a utility bill. Their portfolio is the financial equivalent of watching paint dry. Their retirement account does not care. The gambler. They do not invest. They place bets. Their portfolio looks like a slot machine receipt. They found their strategy on Reddit, in a thread with rocket emojis and the phrase, "to the moon." They bought in because someone on Wall Street Bets posted a screenshot of a 400% gain, and they thought, that could be me. It was not them. When they lose, and they do, they call it paying tuition. They post the loss screenshot like it is a badge of honor. Roughly 80% of retail day traders quit within their first 2 years because they run out of money. The gambler does not have a portfolio. They have a lottery ticket and a Discord server. The Dividend Guy. They do not care about growth. They care about cash flow. Specifically, the $47.83 that hit their account last month from their dividend stocks. They will tell you the exact number. They track it on a spreadsheet, color-coded, with projections. Their entire investment philosophy is built on one sentence they read somewhere. Make your money work for you. They reinvest every penny through drip. They talk about snowball effect the way other people talk about religion. In 20 years, their passive income might actually replace their salary. Right now, it covers 1 meal out, maybe 2 if they skip the drinks. But they will show you the spreadsheet anyway. The crypto bro. You cannot have a normal conversation with this person, not for more than 3 sentences. Because by sentence 4, somehow, it is about Bitcoin. You mentioned inflation, they bring up BTC. You mentioned your rent going up, somehow that is also about decentralized finance. Their phone wallpaper is a price chart. They genuinely believe the entire traditional financial system will collapse within a decade. But today, they still paid for lunch with a Visa card. Americans lose over $10 billion a year to crypto scams alone. The crypto bro is not worried about that. He is worried about you missing out. The landlord. Renting is throwing money away. That is how every conversation starts. This person bought a duplex, maybe a triplex, and now they are a real estate investor. They will calculate at dinner how much of your rent could have gone toward a mortgage. What they will not mention is the 2 a.m. phone call about a broken water heater, or the tenant who stopped paying 3 months ago, or the fact that they spent every weekend for a year watching YouTube videos about rental property math and still lost money on their first deal. They own an asset. The asset also owns every one of their weekends. The app guy. They have Robinhood for stocks, Acorns for spare change, Webull for charts. Stash for long term, Coinbase for crypto, Public for social. There are about 27 million funded accounts on Robinhood alone right now. They have one on every platform, each with maybe $300 in it. They open a new account every time they see a TikTok ad. They feel like they are diversified because their money is in 7 places. It is not diversification. It is fragmentation. Their total invested across all platforms would not cover 2 months of rent. But the apps send push notifications, and that feels like progress. The insider. They have no inside information, but they perform like they do. They speak in a low voice at bars. I am hearing things about this sector. They share articles about CEO departures like they had advance notice. They use phrases like smart money is moving and this is not public yet about things that are absolutely, verifiably public. They follow 14 finance accounts on Twitter and mistake proximity to information for possession of it. They do not have a source. They have a curated feed and an overactive imagination. The saver. They have money in the bank, a meaningful amount actually. They have been putting it away for 10 years. Savings account, maybe a CD. They are proud of their discipline, and they should be. But here is the thing they do not see. At 0.5% interest, with inflation running at 3 to 5% a year, their money is losing purchasing power every single year. Nearly half of American households have no retirement investments at all. The saver is ahead of them, but they are not growing. They are preserving the number while the value quietly shrinks underneath it. Their money is safe, safely getting smaller. The quiet one. You will never hear this person talk about investing. They do not have a take on the Fed. They do not watch CNBC. They have no opinion on crypto, meme stocks, or whatever the market did today. Sometime around the late 90s, they set up automatic contributions to an index fund. Then they forgot about it. Not strategically, they literally forgot. They got busy, changed jobs twice, moved cities, and never updated their login. They check it maybe once a year around tax season, mostly to make sure it still exists. They could not name a single stock in their portfolio. They do not rebalance. They do not panic sell because they do not know there is anything to panic about. And that is the thing. Their ignorance might be working better than most people's expertise. 2 decades of doing absolutely nothing added up to a number that makes the other 9 types on this list deeply uncomfortable. The quiet one does not have a strategy. They have a password they forgot and an account they cannot be bothered to ruin.